Hello, everyone. I'm Michael Lytle, Chief Investment Officer for StoneX Wealth Management. Today, we want to take a look at an old term that seems to be coming up a little bit more in these days. So, bond vigilantes. This is a term we saw in the 1980s and 90s, and it really referred to bond investors who would express an opinion based on the way they thought a given government's finances were being managed. So, they were looking at inflation, they were looking at budget deficits, fiscal policy, monetary policy. And if they thought it was irresponsible or going to lead to inflation, they would sell the bonds off, kind of push rates up, in theory, to get action from that government. So we've heard it more these past few, I'd say even years, but certainly the past year or so, as our current fiscal situation continues to kind of deteriorate. So let's take a look at that, see if we see any relationship to interest rates at this point. First thing we'll look at here in blue is our current federal budget deficit as a percent of GDP. And what you really saw is from kind of the mid-90s into the mid-2000s, a 10 or 15 year period where it had kind of leveled out. And that all changed with the global financial crisis. From that point forward really to today, we've seen a doubling of the federal budget deficit as a percent of GDP. So massive increase. Leveled out largely post-COVID, but certainly the current policies going through Washington from all angles are not going to relieve that upward pressure, it seems. In white, we have the percent of that debt that's held by the public. Same pattern. I would say that it's increased more. So the public's holding more of the debt than it used to. But again, same kind of levels here, massive increase starting in 2008. What's interesting is we layer on the 10-year Treasury is what we're looking at here. There's not a real direct relationship. So from the early 90s down till really 2020 during COVID, rates fell. Certainly little bumps here and there, but on the margin all the way down close to zero. We have seen them lift over the last 4 or 5 years, but really have leveled off since kind of this time last year, up a little bit, down a little bit, but not a material trend at that point. So it seems that rates are trading much more based on outlook for inflation than they are the budget. That may change. So at this point, an environment that seems right for the vigilantes, they seem to be kind of biding their time. So we'll see if that pivots, and we'll see if markets start looking at deficits more than inflation. But right now, that seems to be the focus here. So with that, thanks for stopping by. And hopefully, as you see that term in the media, maybe this gives you a little background on it.